In this set of analyses, we are going to try to understand why ROA and ROE are what they are. So we are going to use what's called the DuPont method or the DuPont decomposition. And what this does is it helps us decompose ROA and ROE into a couple subcomponents, and we can study patterns in the subcomponents to learn about why ROA or ROE are what they are. So as we're preparing this, two questions for you to think about. One, why does Ashley's Attic have a higher ROA despite a lower return on net sales? And two, why does Kadens Closet have a higher ROE despite a lower ROA? So to understand these questions, we're going to work through some of these ratios. Some of these ratios we had computed previously, specifically return on net sales. And by decomposing return on assets into the subcomponents of return on sales and asset turnover, we can see the drivers of ROA. Similarly, for ROE, we can decompose return on equity into three components: return on net sales times asset turnover times leverage ratio. So if we decompose ROE into these parts, then we can see what forces are driving ROA and ROE. So now we'll turn to the Excel spreadsheet. So here, return on net sales, we computed this previously, so we can just pull this down from above, from the green section. And next we'll do asset turnover ratio. This ratio is net sales divided by average total assets. So let's take net sales from the income statement. So we have Ashley's Attic net sales and divided by average total assets. So we have total assets here. Okay, so this asset turnover ratio looks like it's about 1.92. Similarly, for Kadens Closet, we can do net income divided by average total assets. Let's see, let's double check that. So net sales divided by average total assets. There we go. Had a wrong formula earlier. So asset turnover, again, it should be net sales divided by average total assets. So if we look at ROA computed using the DuPont method, under the DuPont method, ROA is going to be return on net sales times asset turnover. So you can see here when we do this, we get the same ROA that we computed the other way. We get 9.56% for Ashley's Attic and 9.21% for Kadens Closet. But by decomposing it into these two subpieces, return on net sales and asset turnover, we can see that Ashley's Attic has higher ROA because they have higher asset turnover, which means they're using their assets more efficiently. Their assets are working harder for them. But now we need to explore why Kadens Closet has a higher ROE, return on equity. So we're going to compute one additional ratio. This is the leverage ratio. And the leverage ratio is going to be average total assets divided by average common equity. So average total assets. So for Ashley's Attic, that's this number, divided by average total equity. So for total equity, remember we have to construct the sum here of these numbers and these numbers in our formula. So if you're looking at our formula, it looks a little messy here, but it's because we're not doing any subcomponent calculations here. Okay, so it looks like Ashley's Attic has a leverage ratio of 1.39. And Kadens Closet, let's see what theirs is. Theirs is going to be the average of this divided by average sum of our equity items here. So it looks like Kadens Closet has a leverage ratio of 1.58. So they have more leverage than Ashley's Attic. So if we're calculating ROE, the DuPont method, this is going to be ROA times leverage. Actually, it's probably better to think about this as return on sales times asset turnover times leverage ratio. So here, this is the 13.3%, 13.27%. It's the same way. And we see here Kadens Closet 14.6%. So now we can look at these drivers. So let me highlight these in red. These are going to be the drivers. So here we can see that part of the reason why Kadens Closet has higher ROE is because they have more leverage. So more leverage just means that they're using more debt to finance their balance sheet. And remember, leverage helps them magnify returns. So to the extent that Kadens Closet has positive ROA, the leverage helps them magnify the returns to shareholders. So if we return to the slides, right? So these are the similar numbers. So we can come back to our discussion questions. Why does Ashley have higher ROA despite lower return on sales? And it's because they have higher asset turnover. Their assets are working harder for them. So their assets are being more efficient. They're running a more efficient operation. For the second discussion question, why does Kadens Closet have higher ROE despite a lower ROA? And that's because they have more leverage. So they have more debt on their balance sheet. And remember that leverage helps them magnify returns. And that's why sometimes the leverage ratio is called an equity multiplier. So when we apply the equity multiplier, this results in Kadens Closet having a higher ROE than Ashley's Attic, despite having a lower ROA. So in the next video, we will discuss how to analyze stocks as an investment and like the price of these stocks and how to think about that. So while you're thinking about decomposing profitability and some of the concepts that we talked about here, I will see you in the next video.